Hello and welcome to This Explainer. Today we are focusing on a really crucial, highly relevant provision for all of us, tax professionals, chartered accountants, and, well, individual taxpayers alike. We're talking about Section 129 of the new Income Tax Act 2025. This section specifically deals with the deduction you can claim on the interest paid on a loan taken for higher education. Let's jump right in.
I want you to think about a very common, everyday scenario. Are you, or perhaps the client sitting across from your desk, currently paying off an education loan? With the skyrocketing costs of higher education globally, these loans are incredibly common. It's almost the norm now. But how exactly does the tax relief on that interest component actually operate under this newly enacted Income Tax Act 2025? If you're managing tax planning, getting your head around this specific legal provision is absolutely essential. So let's dive into this and see exactly how the new law is structured. Here is our roadmap for today. Number 1, Introduction to Section 129. 2, Detailed Provision Breakdown. 3, Practical Taxation Example. 4, Compliance and Documentation. 5, Common Practical Issues. And finally, 6, Summary and Key Takeaways. Section 1, Introduction to Section 129. Okay, so according to the new Income Tax Act 2025, Section 129 provides a very specific, targeted relief to taxpayers. The bare text states that an assessee, being an individual, shall be allowed a deduction for the amount paid as interest during a tax year on a loan taken for higher education. The primary objective here is simple but powerful: to ease the massive financial burden of pursuing higher studies. The government is essentially encouraging education by providing a clear tax incentive on the cost of borrowing. And here's the best part. Notably, there is absolutely no monetary cap on the interest amount you can claim. Now, for decades, we tax professionals relied on Section 80E of the Income Tax Act 1961 for this exact deduction, right? It was our go-to. Well, under the new, streamlined framework, this familiar deduction has simply migrated to Section 129 of the Income Tax Act 2025. It is really important to note the transitional philosophy outlined in the new act. The law gives us a modernized framework, sure, but it ensures that established tax positions, like this crucial relief on education loans, continue smoothly without throwing a wrench into your client's long-term financial plans.
Section 2, Detailed Provision Breakdown.
All right, let's break this down. The crucial point here is understanding the core applicability conditions. Section 129, subsection 1, lays out 4 non-negotiable requirements. First, the assessee absolutely must be an individual. This means Hindu undivided families, or HUFs, and corporate entities, they cannot claim this. Second, the loan has to be for the higher education of the individual themselves or their relative. And relative strictly means their spouse, their children, or student for whom the individual is the legal guardian. Third, the loan must be taken from a recognized financial institution or an approved charitable institution. Basically, you can't claim this deduction on a casual loan taken from a friend or a family member. And fourth, and please flag this as a vital compliance check for your accounting practice, the payment must be made out of the individual's income that is actually chargeable to tax. Let's look a little closer at that third condition. What exactly qualifies as an approved charitable institution? Well, the Income Tax Act 2025 explicitly defines this to ensure there's no ambiguity. It refers to a registered nonprofit organization that was approved earlier under the provisions of Section 1023C of the Income Tax Act 1961, or an institution referred to in Section 80G2A of that same 1961 Act. This brilliantly illustrates how the new Act references established, familiar classifications from the old Act just to maintain that regulatory consistency we all rely on. Now, moving on to another absolutely essential element, the time limit. Section 129, subsection 2, defines a very strict duration rule. The deduction is allowed in computing the total income for the initial tax year, meaning the year you actually start paying the interest, and the 7 tax years immediately succeeding it. So that creates a maximum hard limit of 8 consecutive tax years, no exceptions. If the loan interest is fully paid off before these 8 years are up, well, the deduction naturally stops. It is always whichever is earlier, the 8-year mark or the full repayment of the interest.
Section 3, Practical Taxation Example. Let's ground this in reality. Imagine a client who is an individual professional. Let's say their gross total income for the tax year is 12 million rupees. During that exact same tax year, they paid an EMI on an education loan they had taken out for their spouse. Now, while the total EMI paid out of their pocket was 3 million rupees, the official bank certificate clearly states that the interest component of that payment was exactly 1 million rupees. Under the new Section 129, you would deduct that specific interest amount, the 1 million rupees, directly from their gross total income. This reduces their net taxable income down to 11 million rupees. It's a straight deduction from the gross income, providing immediate, tangible, and substantial tax relief.
Section 4. Compliance and documentation.
For tax professionals, maintaining a rigorous compliance checklist is paramount. We all know that, so first up, you must obtain an official interest certificate from the lending, financial, or approved charitable institution. And you need to ensure it aligns with the prescribed formats under the newly notified Income Tax Rules 2026. This document is literally the bedrock of your claim. It legally separates the interest from the principal. You can't just guess the split. Second, ensure that the financial trail clearly shows the payment was made out of income chargeable to tax. Keep those bank statements handy. And third, when actually filing, ensure the tax returns accurately reflect the new tax year framework under the Income Tax Act 2025.
Section 5. Common practical issues. So, what goes wrong? Here is a very clear look at the do's and don'ts to help you avoid frequent, painful errors. Do claim only the interest component of the EMI. An incredibly common mistake taxpayers make is attempting to claim the entire loan repayment, both principal and interest, under this section. Do not claim the principal amount under Section 129. It will get flagged. Also, do carefully track the 8-year time limit starting from the initial tax year of repayment. Do not attempt to stretch this deduction into year 9 or 10, even if the loan tenure itself is 15 years. The law is incredibly rigid on that 8-year maximum cap.
Section 6. Summary and key takeaways. To wrap things up, here are your 4 key takeaways to ensure immediate practical application for your practice. Step 1. Update your working knowledge and your tax software. What was once Section 80E under the 1961 Act is now officially Section 129 under the 2025 Act. Step 2. Always verify the relationship. The loan must be strictly for the higher education of the individual SSC or their defined relative. Step 3. Confirm the source of the loan is a recognized financial institution or an approved charitable institution, linked back to those specific 1961 Act provisions. And Step 4. Remember the limits. You are deducting only the interest paid out of chargeable income for a maximum of 8 consecutive tax years. That brings us to the end of our analysis on Section 129 of the Income Tax Act 2025. As the costs of global education continue to soar, are you fully leveraging these 8 years of tax relief to offset the burden of student debt for your clients? It's definitely something to double-check this tax season. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.